Hey, this is Kristin Jamieson with Success Mortgage Partners. Our second question from the agents when we reached out asking what questions they might have in regards to a loan officer for their clients comes from Jeanette Erkberg with Century 21 Carlano Realty and Investments. And her question read, I need a little more clarification on USDA guidelines and what qualifications the buyers need to obtain an approval for a USDA mortgage. Well, Jeanette, there's three basic requirements for a USDA mortgage. The first requirement is the borrower has to be purchasing in a USDA eligible area. Fortunately, in our area, all of Lake County is eligible, and most of our surrounding counties are eligible as well. So we can kind of check that one off the list if we're purchasing in our area. The second one is they have to meet household income requirements. And it's not just the buyer's income, it's actual household income. So if they have children over the age of 18 living in the home, that income would go into it. Their spouse, if they're not on the loan, their income would go into it. But for easy numbers, and I'm just going to talk about our county and Lake County, Florida, a family of 1 to 4 can't make more than $75,850. And a family of over 4 can't make more than $98,000. Now, when we talk about the income limits, there are things that can be deducted from income, which helps some people that maybe are on the higher end of that income spectrum to qualify for a USDA mortgage. So, such as childcare, we get to deduct childcare out of the income since it's something that the family has to pay in order to go to work and earn that income. Another deduction is if we have any older adult family members that may have moved back into the home, we can deduct out their disability expenses or their annual medical costs. So it's not a hard and stone guideline. It's just a kind of a guideline to follow. And again, if anybody has questions in regard to that, please don't hesitate to reach out. The third guideline is at Success Mortgage Partners, we require at least a 620 credit score. So it's on the lower end of the credit spectrum, so it's not crazy for people to qualify, but we do need that benchmark to be met. And that's if they have a credit score. So USDA does allow no credit scores we can do financing for no credit scores. However, it has to be a true no credit score. Bad credit doesn't take away from no credit score. There's just some people out there that have never utilized credit, and that's okay. They don't have bad credit and they just have none. So in that case, we would be looking for alternative credit to fill their credit profile, such as we would have to verify their rental history over the past year. If they pay car insurance, if they pay cell phone, if they pay electric, gas, water, their utilities, we would add that to the application to support it. So those are the three basic qualifications. One thing that USDA is looking for is they're looking over the last 12 months. So even if somebody has a 620 credit score, but they may have had quite a bit of derogatory credit, maybe collections popping up or late payments on their credit report over the last 12 months that can't be explained, that weren't out of their control, it might make them ineligible until they had a clear 12-month payment history on all of their accounts. Another thing that USDA is very strict on is their debt to income ratio requirements. Since it is a 100% financing loan, they want to make sure that the buyers getting in can afford their payments. So they're more strict than some of the other loan programs where they're only going to allow us to use 29% of their income for their housing expense and 41% total income for all of their other expenses. But it allows them to get in their house and not be house rich and dirt poor, which is good for our first-time home buyers. Or, I mean, you don't have to be a first-time home buyer to use the USDA loan program. It's out there for everybody as long as they don't own another house, but it's just something to keep into consideration. Lastly, the other thing that might be a deal killer is if they do own another house. You can't have 2 mortgages with a USDA loan. There are some exceptions to the rules, like if you're being relocated from out of state and you possibly, you can't sell your house, or you don't have time to sell your house prior to needing to move to start your new job. There are some exceptions that can be made, but again, they're going to be very strict on their debt to income ratio requirements. So we'd have to make sure the buyer, qualified with both payments if they fell into one of those exceptions. Other than that, it's just a conventional loan with FHA appraisal requirements. So there can't be any health and safety concerns to the home. as far as the appraisal is concerned, but the rest of the guidelines are the same as a conventional loan. So if you have any more questions in regards to USDA mortgages, their qualifying guidelines, credit score requirements, or anything else, please don't hesitate to reach out to myself or my team, 352-242-1535.